Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, investing in a volatile market, part 1 in our series on basic education for financial literacy, sponsored by LifeSize Solutions and the Society for Financial Awareness. Well, welcome everyone to the first segment, investing in a volatile market. Now, I want to talk about this now because when corrections come, when bear markets come, I kind of want us to prep our psychological profile for this because it's difficult to go through times of correction and bear market. But let's walk through some basic investor scenarios so that you understand what you're getting yourself into when we're talking about buying mutual funds, ETFs, REITs, things that are driven by the market, things that could lose money. I mean, they could lose all your money when you think about it. So let's look at this. When the market is down, your share price has dropped, but your number of shares has remained the same or increased through capital gains and dividends reinvested. So most of us are letting our capital gains, we're reinvesting all the time in mutual funds and our ETFs, which are basically the staple of most 401ks. In order to declare a taxable loss or gain, the investor must act upon his or her account to sell. Now remember, that's predicated on this amount of money is not in my 401k, my IRA, my Roth IRA, any of my pension work. This is outside non-qualified money because that does matter on tax issues, even in a loss position. So we'll talk about that in a second. However, if your account has dropped in share price and you have not sold the investment, the account value is just down because you haven't taken constructive receipt yet. And if it's outside in a non-qualified plan, we don't know if we're going to have taxes or not. I hate to bring this up all the time, but think about it. You could actually have a loser mutual fund and or an ETF. And those funds could, and their final statement for the year, show a loss. And then about a week later, you could actually get possible a 1099 from the same mutual fund and or ETF and saying that you owe taxes because the ultimate person that pays taxes on any of these funds, especially in non-qualified plans, is ultimately going to be the owner of the fund. So we own our mutual funds, we own our ETFs. If they forward any of the capital gains that have been happening throughout the year, even though our overall fund is a loss, we still may owe taxes. This is why some people have a great aversion for using market-driven instruments outside a non-qualified plan because it just exposes it to additional costs and of course then takes your internal rate of return or your net rate of return down. Number 3, buying when the market is down is almost always a wise decision. Now I know it's tough. You don't know where the floor is. Nobody can time the seller. Nobody understands the basement. We don't know how far down it'll go. But when I'm buying, sometimes I like to just keep buying at the bottom. And even though I haven't hit quite bottom, I'm not going to be able to time it. So I'm trying to become a disciplined investor, dispassionate about how I feel, dispassionate about my emotions, feeling kind of a little uptight about the market having its problems. I want to be able to purchase when the market's going down. And again, not trying to time the floor. When you switch, move, or reallocate your money within your portfolio, you are acting on the account. You're first selling the existing shares and probably purchasing new shares in a different account. If the account you sold shares from is down, you are declaring a loss and hoping what you can do is switch so that the market will bounce back. And by the way, if you have non-qualified monies out in the market right now, you might want to look at it as an end-of-the-year tactic. You might want to take your gains of all your mutual funds and ETFs against all your losses of your mutual funds and ETFs and try to match up those tax harvesting tactics. In other words, I'm going to try to take my losses and my gains and neutralize as much as I can. And this is a good time to start thinking, should I take money off the table on the things I have done well on? And do I have any loser funds or loser ETFs that I can go ahead and match and try to offset my taxable event? A couple other things. Income is what we earn. Now, I like dividends from stocks. Sometimes the appreciation may not be as good as the actual income or the dividend it produces. But I want to look at income, and it could be dividends for stocks. It could be the interest rate on a bond. Wealth is what we get to keep. I've paid all my bills. I paid all into the future. I have everything, all my obligations of the future done. I want to know what it's like to start building wealth. I want to know what it's like to have a portfolio that's building wealth into the future. If not for myself, could be for my children. If not for my children, their children. And maybe even a nonprofit organization that I want to be the benefactor for. And I want to help them out and really make them an ongoing concern, even when I'm not around, when I transfer all my estate assets to the charity, my children, and who else. So Debt keeps us from the opportunities of wealth accumulation. I like to use the acronym DEBT. Destroys equity built over time. Nothing else destroys equity than ongoing debt. We're the first generation, the baby boomers, who have actually participated in bringing a mortgage into our retirement, unheard of in preceding generations. So it's really important for us to get this down. We're trying to get rid of our mortgage before we head into retirement. We're trying to reduce all our debt, our tuition payments for our children, long-term care bills accumulated by our parents. The goal there is to reduce all of this and come to a place where we can actually have some freedom and start to accumulate and use our cash flow to do other things, even things that are discretionary and fun things that we want to do. Our behavior towards finances creates our money handling habits, which puts us in or takes us out of the game. We have habits, we have routines, we have maybe disciplines or lack of discipline. And part of that discipline is really thinking dispassionately about it. If you ever watch the show Shark Tank, I love Kevin O'Leary. He always is a disciplined investor, he says, and he's dispassionate. He just looks at the money, not at how he feels, not about his emotions. He's looking strictly at the math and is it a good deal or a bad deal? So when I'm looking at basic ideas, I want to look at my behavior because most of the time, and this is so hard to bring up, our behavior causes us more problems in investing than probably the actual stock, bonds, mutual funds, or ETFs that we're buying. We're always buying, we're getting out because we're too afraid of the bottom. We're not buying low because we're thinking about how low will it go. We have to become disciplined investors, and we have to find scenarios that we can do to help increase our wealth. So we want to increase our wealth through accumulation. If I'm reducing my debt, I can start putting more money into accumulation. I want to do this for a couple areas. I might want to accumulate money for my children's education. I might want to accumulate money for my own personal retirement. I want to accumulate money for especially my long-term care because it's going to be a big bill in retirement. And of course, I want to transfer to my children, grandchildren, and maybe even grandchildren the way we're living today, and charities of my choice. So I want to be able to accumulate wealth and be able to hand it to other people. To do that, though, I have to get out of debt and start looking at areas where I can create cash flow, especially in retirement. I want to reduce taxes and stay ahead of inflation. Listen to those two ideas. This is a tandem problem for most investors. The tandem issue is taxes. I need to modify and manage my taxes during retirement. It's one of the greatest places I can go immediately to create 10 to 15% more cash flow if I just manage my income, my constructive receipt of income coming from qualified plans, non-qualified plans, tax-exempt ideas like HSA accounts, life insurance, reverse mortgage, Roth IRAs. I need to manage that because it reduces my tax bill and gives me more money to keep. Heck, it's my money, I might as well keep it. Inflation. I always want to have some in the market though, or if I'm buying an annuity, buy maybe a cost of living or adjustment to it so that I'm always adding on or getting an increase to match up to inflation. It's the power of my purchasing dollar during retirement that's going to matter. And these two areas, taxes and inflation, can be really problematic. So I need to learn how to get a hold of it and manage to it. I also want to build a plan with a solid financial strategy. It's amazing to me, my generation, the baby boomers, that the majority of us, the vast majority of us, do not have a financial plan today, and we certainly don't have a retirement plan with strategies and tactics for tomorrow. It's really important to put down a plan. I can't imagine watching an NFL game and a coach not planning how they're going to attack on the offense and how they're going to attack on the defense. I can't imagine not coming with strategies and tactics so that I can win and have a lifestyle during retirement that's really the happy factor of how I'm going to live my lifestyle. So it's really important. And then the last one, having enough money to live on with your life options. You have to define what is my obligations, what are my discretionary spending, what do I want to do in the future for my children, grandchildren, or charity of a choice? I want to map that out and figure out what that is. Most people do not realize what their obligations are. Now, Social Security will take care of some of those obligations. But generally speaking, the difference between Social Security income and my actual bills, obligations, not discretionary, but obligations, Or generally there's a gap there and I have to make up for that and somehow. A lot of times I use lifetime annuities because it's a guaranteed income I can't outlive, because I have guaranteed bills I'm going to have to pay forever. I like the inflationary issues there. So when you're thinking about having enough money to live on with your lifestyle and having some options and some flexibility, that's why I like to do tax diversification as well. Taxable items, tax deferred items, and tax exempt items. This is why it's important to learn some of the basics so we can understand what financial literacy is and use it for our advantage. Don't forget to watch our next segment on learning entry-level economic terms, part 2 in our series on basic education for financial literacy. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.